Another bank failure this week in the United States and concern about others following the collapse of Credit Suisse in March. What's behind these events and the recent volatility in the sector? And are there risks of a broader financial crisis? This is Inside Story. Hello, welcome to the programme. I'm Adrian Finighan. Concerns about the stability of banks in the United States and elsewhere persist. First Republic failed this week. Another two banks collapsed in March. The White House is keen to reassure Americans and the world that everything's under control. But the sector is at its most volatile since the 2008 financial crisis. The recent collapse of Swiss giant Credit Suisse means that shockwaves are rippling through a globalized and more interconnected financial system. So are these isolated, unconnected events or signs of something deeper and more worrying? We'll be finding out what our guests think in just a few moments. But first, a report from Malagabi Motsepe.
Regulators in the United States seized embattled First Republic Bank early on Monday and promptly sold it, hoping to end the turmoil that's raised fresh questions about the health of the banking system. First Republic was one of the lenders battered by a crisis in confidence in March. Clients with large accounts were quick to pull their money at the first sign of trouble following the failure of Silicon Valley Bank and Signature Bank. They and First Republic were hurt by rate hikes.
It looks like the Federal Reserve will probably continue raising interest rates, and that will compound the problem that First Republic Bank faced, where it was earning less interest on its loans than it was paying for its liabilities.
The collapse of San Francisco-based First Republic is the second largest in U.S. history. J.P. Morgan Chase took over the bank in a deal brokered by regulators, but it renewed political debate about financial regulation.
If your bank fails, you should be required, the regulators should be required to claw back the executive compensation for the last 3, 4, 5 years. Similarly, if your bank fails, you should be barred from ever being an officer or director at a bank in the future.
There are worries too about bigger banks becoming too powerful as a result of government intervention.
The U.S. has backed itself into a corner where the way that we protect uninsured depositors when a bank fails is to have a larger bank gobble it up. That then makes the larger bank more likely to be too big to fail. And each time this happens, the problem is compounded.
In Washington, President Joe Biden attempted to reassure people that there's nothing to worry about.
These actions are going to make sure that the banking system is safe and sound, and that includes protecting small businesses across the country who need to make payroll for workers and their small businesses.
Concerns about the banking sector aren't just confined to the U.S. In March, Swiss authorities forced Credit Suisse to agree to a takeover by rival UBS. The demise of its second largest bank severely damaged Switzerland's reputation for financial stability and dented sentiment among investors further afield. Malagabi Motsepe for Inside Story.
Well, let's bring in our guests for today's discussion. From Los Angeles, we're joined by William Lee, Chief Economist at the Milken Institute, an independent economic think tank and a former division chief at the International Monetary Fund. From London, Vicky Pryce, Chief Economic Advisor at the Centre for Economics and Business Research, one of the UK's leading consultancies. And in Massachusetts, Cornelius Hurley, lecturer in financial law at the Boston University School of Law and former Assistant General Counsel of the Federal Reserve Board. A warm welcome to you all. William, let's start with you then. Why did First Republic go under? Is it a sign of a broader banking crisis?
We have a crisis in bank supervision, not a banking crisis. What we've seen fail are badly managed banks or specialized banks that took very strange business models that deviated from standard banking. Standard banking generally says that you should diversify your loan portfolio, and the United States is a very different country than many countries in Europe and Asia, where there are over 4,000 banks in the United States, but banks only account for about 11% of total corporate financing. So the corporate sector really depends upon capital markets more than they do banks. However, banks do service the small businesses. And what we found with the failed banks is that the managements of those banks chose to specialize in either cryptocurrencies or venture capitalists or chasing after rich people and rich deposits. And those models are very specialized and highly undiversified. And so they were subject to runs that came about because interest rates started going up. So we have a series of bad banks. And there are many bad banks in the United States that the supervisors have failed to identify and shut down. So that really is the problem, not a systemic problem in the banking system per se.
Vicky Pryce, do you agree with that? We have a series of bad banks. I mean, how can a bank be hurt by a Federal Reserve interest rate hike? I mean, surely isn't an interest rate something that banks pass on to their customers?
Oh, that is absolutely true. I mean, what tends to happen, of course, is if interest rates are high, then what you or are on the way up. What banks do is that they charge a lot more on their loans, but they don't necessarily increase deposit rates, interest rates, as fast as that. So they make a bigger margin. So if you are a normal retail bank, which is diversified, then you do reasonably well when interest rates go up. You don't do so well when interest rates are low. The trouble is, of course, there are quite a lot of the banks that we're talking about, but also wider. If you look at what happened over in Europe with Credit Suisse, is that you have a retail bank, you have a commercial side of it, which of course lends quite a lot to businesses, which may be in greater difficulty because of the higher interest rates themselves, so they have to pay on their loans. And then you've got a wealth management division, which is the one that Credit Suisse also had, which was quite, doing reasonably well, but where money started flowing out of it. But also you had a very strong wealth management division as well in the First Republic Bank as well, which was the one that JP Morgan decided it really wanted to have. That's why it bid for it. Now, it varies significantly how those various bits of a bank do, depending on what happens with the cycle and also with interest rates. And it is absolutely true that if one isn't diversified significantly, because one specializes maybe in the tech sector, which is what was happening with a number of the banks in the US, or you're quite small relatively in relation to sort of the wider market, and you depend a lot on particular deposits which may suddenly disappear, so you're not as diversified in your deposit base either, then you're in greater risk of changes in the environment, particularly changes in interest rates. And a number of those smaller banks, which tend to specialize indeed, have tended to also not only specialize in the tech sector and commercial property, but they also have tended to invest in relatively safe assets like treasury bills in the US, in other words, bonds, government bonds, which have tended to be very safe. And yet when interest rates go up, of course, the value of those bonds goes down very significantly. So when people withdraw the deposit suddenly because they're worried about you, and you try to sell those assets you have, which are bonds, which are falling in price, then you have a serious imbalance developing, and you end up having to be rescued or have someone buy you, or basically folding, which is exactly what we've seen happen in a number of cases in the US recently.
Excellent. Cornelius, First Republic had been looking for a suitor in the weeks leading up to the purchase of its assets by JP Morgan. If market forces had been allowed to play out, it didn't find a buyer, and it had been allowed to collapse, what would have been the repercussions?
Well, I think the policymakers who are concerned mightily about the spillover effects of a failure, particularly with regard to the regional banks. I agree with all that's been said previously, except for the clawback comment. I'd like to go back to that if we might later. But, what we have in this current situation is unusual from past crises. In past crises, the problem has been with assets, mainly loans and investments. Here we have 2 banks, 3 banks, 4 banks now that have failed. largely due to their liabilities, to their deposits. And that has been compounded by technology. Policymakers really haven't caught up to the fact that customers, be it retail or commercial, can move their deposits with a click of a mouse, in seconds. We tend to think of bank runs as depositors lined up at branches, but that's not the nature of a bank panic today. Today, it happens in minutes and hours, not in days and months. That said, I agree with the previous commentator who said that we have a bank supervisory crisis more than a banking crisis. The bank supervisors, and I'm thinking particularly of the Federal Reserve, and the Federal Deposit Insurance Corporation, were well aware that these banks, particularly First Republic and Silicon Valley, had significant problems as much as 9 months ago. And their failure to act deserves much more scrutiny than it's gotten to date. There has been a report by the Fed and the FDIC. However, those were entirely superficial, and I think with congressional hearings to come and more research on this, we will validate your previous speaker's comment that this was largely a supervisory problem and not an inherent banking problem.
William, it was you who made the comment about the supervisory problem. But to what extent did the markets themselves play a role in the collapse of not just First Republic, but the other US banks as well, in that the markets smelled blood? There was a certain amount of manipulation, market manipulation and short selling that went on. And did that contribute to the collapse of these US banks? Should short selling of bank stocks be banned? You may have to explain for us what short selling is before you give us the answer.
Yeah, I think one of the things that we have to remember is that the markets start to smell blood in the waters because the supervisors and the bad managers put the blood there. Don't forget, as interest rates rose, not all banks had problems. Well-managed banks were able to manage their liabilities, keep their depositors, and offer them services that retain their highly valued customers. What we found was that First Republic, Silicon Valley, and the crypto banks that specialize in cryptocurrencies failed because their managements did not put in place the proper governance and risk management structure that most banks had in place. Take, for example, Silicon Valley Bank. They operated for over 9 months without a chief risk officer. And the chief risk officer is one of the most important people in a bank because that person's responsibility is to make sure that they take into account all foreseeable risks. And in the environment that we were in, it was absolutely clear that as inflation started to take off, the Federal Reserve was going to start raising rates. And yes, I agree, the Federal Reserve raised rates at a historically fast pace, but banks should not have been caught so flat-footed that their customers panicked. And now we do have a new technology where bank panics are now induced or catalyzed by social media. So in Silicon Valley, which had people that were subject to a lot of groupthink, you had one social influencer put out a huge message via their social media that said, hey, pull all your money out because Silicon Valley is not as safe as you think. And suddenly everyone did that. Well, the risk manager should have known that their people, their customers, were subject to such groupthink and had diversified their asset management and their liability management. So not all banks suffered because interest rates went up. And the evidence for that is look at the larger banks, JP Morgan, Citibank, and Bank of America. They were all subject to the same interest rate environment, and they fared very well. Look at the other smaller banks around the country, the other 4,000 banks. All of them managed to survive quite nicely. Unfortunately, markets are suddenly getting the thought in their head that perhaps the U.S. banking model of having community banks servicing small businesses is not a viable model. That is wrong, and that has to be something that the supervisors come out and absolutely state explicitly that they fell on their job, they fell off on their jobs, and because of that, markets panicked, not because of anything wrong with the banking system per se.
William, is there perhaps something more, it's a naive question, I'm sorry, but is there something more nefarious going on here in that there are those in the markets who would be willing to push smaller, struggling banks towards collapse so that the Federal Deposit Insurance Corporation, the FDIC, steps in first and then gives any potential buyers better terms?
There are always nefarious investors out there looking for vulnerabilities, but a short attack, that is an investor that tries to attack an institution by selling their stock and trying to induce their price decline and panic their management, would never succeed if there weren't fundamental vulnerabilities. And one of the things that we found in the past were that speculators always lost money unless there was something to win. And we saw in very many different places, including as big an institution like the United Kingdom, George Soros was able to break the pound because he was able to induce so much volatility in the foreign exchange market that the British pound suffered. So there are many speculators out there, but if you have a sound institution, you actually will find that speculators will try and they'll fail. The reason why they succeeded with Silicon Valley was that there was something there.
Vicky, what are the implications of this for European banks? I mean, the two systems have very different regulatory systems. Is there any similarity between what's going on right now in the United States with Credit Suisse and UBS?
I think, as we've heard, there are many more banks in the US, lots of regional banks, specialized banks, a lot of smaller banks, which is good, actually, in terms of supporting local communities or particular sectors. In Europe, there's been huge amount of consolidation that took place after the financial crisis. So we have many fewer banks, and they are very tightly regulated. I mean, remember, in the US, of course, under President Trump, there was a deregulation, particularly of the smaller banking sector, which is, I think, one of the problems that we're facing right now with the issues that have arisen. In Europe, it isn't quite like that, but people still can move their money out very fast. The way in which the system now works is such that with electronic transfers, there can be a run on a bank, which can be very, very quick. And one of the things that happened, of course, with Credit Suisse, which in the end had to be bought up by UBS, has been indeed this lack of faith, if you like, that the bank was going to be a going concern sort of going ahead, looking forward. So you can have the same things happen in Europe too, but the real concern is that because there is a bit of an issue as to the sustainability of the banking system at a time when interest rates are rising so fast, and there would be bad loans without any doubt, and a lot of lending was given when interest rates were low, and there's a lot of commercial debt, commercial property debt out there, that we may indeed see that there is a tightening coming ahead in lending and credit conditions. We've seen that already in Europe happening. A lot less willingness to lend, a lot more concern as to what the implications would be, trying to avoid having anything like what's going on in the US right now spread into Europe. And that is bad. That is bad for businesses, bad for consumers. It's also, of course, bad for the economy as a whole. And there is a concern that with interest rates continuing to be raised by central banks, we might see a slowdown in the economy at a faster rate than would otherwise have been the case. And already, of course, in the US, one is talking of a possible recession because of everything that's been happening later this year or possibly 2024.
Cornelius, are big banks a bad thing? And where's the Biden administration in all of this? There was a long-held view that the government would block banking giants getting any bigger. Biden himself had vowed to take a tougher stance on bank mergers when he came into office, and yet he said that he was pleased by the First Republic deal. He said it would make sure that the banking system is safe and sound.
Yeah, so we have in this country and in many countries what we call too big to fail banks. And if you think about that term, what it means is a bank is either too big or complex or interrelated, that it will not be allowed to fail. That implies a significant government taxpayer subsidy of that bank because it will never fail. So whenever you have a bump in the road, like we're experiencing now, deposits either flee voluntarily to those too big to fail safe banks or involuntarily, as in the case of First Republic, where the government acts as a chaperone to make JP Morgan Chase even larger than it was before. we had other banks that were interested in buying First Republic that were not too big to fail themselves. And I'm thinking in particular PNC Bank. But I'm disappointed in the administration in that they actually subsidized the purchase of First Republic by JP Morgan, thereby making JP Morgan even larger and more too big to fail than it was before. This is the unfinished piece of business from the last financial crisis in 2008, where we failed to right-size these institutions. Now, if we're willing to live in a world of basically socialized banks that are wards of the state, then we ought to make that conscious public policy decision. But instead, we tend to fool ourselves into thinking that we have a competitive system, when really what we have in the U.S. is a subsidized too big to fail. After all, the too big to fail banks account for about 60% of all banking assets in the U.S. And as William pointed out, the U.S. system is not as bank-centric as the European system. But we have this dichotomy, and ultimately we're going to have to reconcile it.
William, is JP Morgan too big to fail? Is Jamie Dimon, the man who runs it, too powerful? What are the dangers of US banking consolidating around a handful of these too big to fail banks, both for consumers, who of course will face less choice, and for the government?
The notion of having very big banks is something the administration, all administrations and bank supervisory regulatory agencies are well aware of. And I think they would have rather PNC bought First Republic. Unfortunately, by law, the FDIC was mandated to always accept the least cost solution. And JP Morgan outbid PNC, simple as that. Now, what we can do going forward is to make sure that the competitive pressures are restored and that JP Morgan isn't given an unfair advantage just because they're too big. And you're absolutely right. When you have a large bank dominating so much of the banking system with so much of the assets, if they make a mistake, then surely the taxpayers will be on the hook. And so that means that going forward, the regulators and supervisors have an even tougher job to make sure that these large banks do not fail. So we should put much more effort going forward on the supervisory responsibilities for making sure these banks operate properly. What we see, unfortunately, in the U.S. Congress is a movement toward changing the regulatory structure so that smaller banks get more emphasis and we reverse some of the deregulation that went on in the past. The purpose of the Trump administration deregulation efforts was to focus all of the supervisory attention, or at least more of it, onto these systemically important banks, because if any one of these banks failed, it would be a catastrophe for not only the U.S. financial system, but also the global financial system, because they are so interrelated and so international and so global.
Vicky, to what extent has the increasing volume and complexity of banking and trading made banking riskier, not safer, since the 2008 financial crisis? Does Europe have its fair share of too big to fail banks?
Of course it does. I mean, if you look at each country, there are a handful of banks that dominate. I mean, of course, in Switzerland, which is what has been the focus of attention recently, we really only have two big banks, and now there's only one. So you can imagine what that means in terms of too big to fail. Absolutely. We do have loads of those banks which have to have in order to operate a proper sort of resolution regime, if you like, which has been agreed not just across the EU, but also internationally. And those rules are still there, but they seem to in many ways sort of change when the need arises. Like, for example, what we saw in Europe with Credit Suisse, where it ended up that it was bondholders who lost out, or special bondholders who lost out significantly, whereas shareholders lost out less. So rules can be changed overnight. So even for those who invest in the banks, not just have money deposited, is becoming a considerably more risky situation. But what's going on right now in Europe is a talk of possibly increasing the deposit guarantees that are offered, because a lot of deposits, of course, are uninsured and they could cause a run at any point. In the US, the deposit guarantee is $250,000, and that may go up. So far, with all the bank failures we've had in the last few weeks, all deposits have been guaranteed, not just those up to £250,000. In Europe, it's a lot less. It's about 100,000 euros across the EU, and it's £85,000 in the UK. There is now talk of increasing that. And of course, just as we've been hearing from the other contributors, that could well mean of course, that the taxpayer at the end may have to fork out more money to support those banks. But that makes it also a lot more difficult to let any of those banks go, because you're now guaranteed so much of that money. You've got to keep them going. And I think we're going to see probably this move to consolidation continuing, but also, I think, supervision of those big banks tighten as well to make sure that there are no risks attached.
Cornelius, how worried should the likes of me and anyone watching be worried about all of this? Is there going to be another credit crunch, as there was, of course, the one that precipitated the 2008 financial crisis, or should we rest easy that the banks and the governments know what they're doing and there's nothing to worry about?
Yeah, I don't know about a credit crunch, but certainly the upshot of much of this is that banks will be much less eager to lend. And that's probably less of a problem in the U.S., where banks are not that significant a part of the financial system, as opposed to the EU, where it is highly bank-centric. I will point out one feature of the U.S. banking system that I think is very concerning. And most of your listeners probably have never heard of this, but that there is a $2 trillion government facility, approaching $2 trillion, that lends indiscriminately to banks. And in doing so, it masks many of the problems that these 4,000 banks that William alluded to earlier have, thereby interfering with the market discipline process. That system is called the Federal Home Loan Bank System. It has been around for 90 years. However, it has never been as large and as systemically important as it is today. And its fingerprints are all over the bank's failures that we're talking about today, all over them. For example, it had almost $30 billion in outstanding loans to First Republic. And comparable amounts to some of the other banks that failed. So that's a policy feature of the U.S. system that European banks do not have to be concerned about.
Okay. Very, very quickly, Cornelius, in answer to the question, should I be worried? Yes, no, maybe.
I would be cautious. Be cautious. People are paying a lot more attention today to the metrics of what is insured and not insured. It's a reasonable thing. It's not panic to move your money to either a money market mutual fund or a too big to fail bank.
Okay. There, I'm afraid we're going to have to leave it. We're out of time. Many thanks indeed, William Lee, Vicky Pryce and Cornelius Hurley. As always, thank you for watching. Don't forget you can see the programme again at any time by visiting the website at aljazeera.com. For further discussion, join us at our Facebook page. That's at facebook.com/AJ Inside Story. And, of course, you can join the conversation on Twitter. Our handle at AJ Inside Story. From me, Adrian Finighan, and the team here in Doha, thanks for watching. We'll see you again. Bye for now.